Podcast is now starting. All attendees are in listen-only mode.
Good morning and good afternoon, ladies and gentlemen. My name is Andrew Gilmore from the DIS sales team, and I want to thank everyone for joining us for another Wednesday webinar. We know your time is valuable, so we do appreciate you taking the time out of your busy day to meet with us. Today's topic is one of my favorites. It's the Disability Insurance Crash Course. Today we'll be going over all the important features in a disability contract. I will be leading the presentation along with our Business Development Manager, Mr. Ben Coleman. As well as going over some of the key features of a disability contract, Ben will be discussing some time-tested approaches and techniques to selling disability insurance, and he'll also sprinkle in some great sales ideas. Before we start, I want to go over a few items. We can't hear you, so if you do have questions, please type them into the dialog box on the right side of the screen, and if time permits, we'll answer them at the end of the presentation. So let's go ahead and start. Ben?
Hey, Andrew, thank you. As Andrew mentioned, folks, welcome. Thanks for being here for another Wednesday webinar. The DIS Crash Course, a little DI 101. This one is very important because even if you are a seasoned veteran agent selling disability insurance, or you're new to selling DI, maybe you haven't sold much of it in the past, this is a good refresher and also a good way to learn these terms that you're going to be seeing on the DI quotes that we sent to you, or the policies, whatever it may be, applications. So let's jump right into it. As Andrew mentioned, I'm also going to give you guys some sales ideas that you guys can go out and use today. So here's what we'll be talking about, both Andrew and myself. We're going to go over the need for disability insurance. You have to emphasize the need, folks. It is the risk is real, and I'm going to point that out by using statistics and facts. We're going to go over the terms. We're going to talk about the disabling definitions. You may have heard of true own occupation. Andrew's going to talk about that, along with the modified ONOC and ENEOC, the different renewability provisions, a non-can contract versus a guaranteed renewable. What if provisions? What if this were to happen to me and I became disabled? Those are built into the contract. I'm going to go over those. Then we're going to talk about the riders that you can add onto the policy to help strengthen it. And we'll discuss some of the DI exclusions and limitations that you'll see on contracts. And then finally, we'll wrap it up with a little Q&A. As Andrew pointed out, you'll have to type the questions in the box on the side of your screen, and time permitting, we'll do our best to answer all of your questions. So let's jump right into it. As I pointed out, disability is more common than you think, and it can happen to any one of us. Even though most of us don't wake up in the morning and envision ourselves driving down the street with a handicap placard hanging from our rearview mirror, it's still a very real possibility. So the DI disability is meant to be sold. It's not going to be bought. That's my point, is that they're not going to wake up in the morning and call you or call DIS and say, you know what, I think I'm going to buy some disability insurance today. People just don't think that way. So you have to emphasize the need. And the best way to do that is with actual statistics. Now, these are just two stats that we have right here. We have plenty that we can provide you with, and we actually have our DI Statistical Power Pack. If you haven't seen that, please contact us. Let us know. Let me email you that today. It's a nice one-page PDF with about 15, 20 statistics that are just outstanding that you can bring with you on your next meeting with your client or with your prospect. So look at these two stats. Did you know that over 51 million Americans are classified as being disabled in our country today? And that's actually from the 2006 census. It's probably more now because we just did our recent census in 2010. But 51 million Americans, that's a staggering statistic, and that actually makes the disabled in this country the largest minority in our country. So if you wanted to have some fun with the statistic, you can actually, when you're sitting there with your client and talking to them about disability, ask them if they know what the largest minority in this country is today. And I can tell you the first thing that popped to my mind was an ethnic group or a race, but the answer to that question is not. It's the disabled. So that can almost be used as like a trivia question, but it's still an amazing statistic. 51 million people in this country are classified as being disabled. And then this one's a good stat as well. A disabling injury occurs every 2 seconds. So two good stats right there. As I mentioned, if you're interested in getting that DI Stat Pack, the Power Pack, please let us know. Before I move on, there is one quick sales idea I want to provide you with right now, and that is when you're talking or presenting disability insurance to your clients or your prospects, I don't want you to call it disability insurance. I want you to call it paycheck protection, because that's really what it is. You know, don't tell me, or excuse me, that's what it does. Disability insurance is paycheck, it's protecting the paycheck, their most important asset, their ability to earn an income. So use the term paycheck protection. That's going to relate more with them. You know, that's their vernacular. That's how, you know, they're going to speak. All of us are in the insurance industry. We're familiar with the alphabet soup of terms and acronyms that we deal with on a daily basis, but a lot of people out there in the general public, they are not. You know, they're not familiar with those terms. So call it paycheck protection. Okay, well, at this point, we're going to go over some of those common terms you're going to see on DI policies, and for that, I'm going to toss it back to Andrew.
Thanks, Ben. Yeah, some common terms that we're going to go over on this slide really describe the structure of a disability contract. And so the first term you want to know is the elimination period. What is elimination period? When you see that, think waiting period. It's the time in which your client who's been declared disabled by a physician has to wait in order to receive the monthly benefit amount. Some of the typical elimination periods are 30, 60, 90 days. We can go as far as 180, 365 days. Probably the best elimination period, the most bang for your buck, is 90 days. So if you're considered disabled on January 1st, you're most likely going to receive your benefits on April 1st. The benefit period, how long can your client collect disability consecutively? Some typical benefit periods are 2 years, 5 years. Some carriers have added a 10-year benefit period. And probably the best and the one we recommend the most is to age 65, or with some carriers to age 67. You want to try to give your client the best protection. That's why we recommend to age 67. But there are certainly situations in which a 2-year or a 5-year might be appropriate if you have older clientele, or if the person's on a tight budget. The rule of thumb with that is any form of disability is better than no disability. All right, the benefit amount. What is your client going to actually receive from the DI carrier? Well, it's going to be paid out monthly. And how you can, if you don't have the numbers right in front of you, how you can get a good idea of how much your client would qualify for is take 60% of the gross pay, or monthly gross pay. So I always use the example of I make $100,000. The monthly benefit for that would be roughly around $5,000, and that works out to be about 60%. We have some exciting news. DI carriers are expanding their participation and issue amounts constantly. Currently, right now, an individual, if the income qualified, could get up to $20,000 per month in monthly benefit amount. And then again, if they have group or individual already in place, we can participate to $30,000. So definitely always feel free to let us know how much they make, because we can certainly get up to a high monthly benefit amount.
That's great, Andrew. And I've also, the one thing I think you want to ask your clients or prospects when you're talking to them about this is, how long could they go without their paycheck? That goes back to what Andrew touched on the elimination period or waiting period. And that's why we do typically quote 90-day elimination period, is because most people could hopefully survive 3 months without any steady income coming in. But that's really the question you want to ask, because maybe your clients, you know, they don't have enough in savings, or the spouse isn't working, and maybe they can only afford 2 months. So that's when you want to quote a 60-day elimination period. Or perhaps your client's making plenty of money, and in order to save some money on the DI contract, you're willing to do a 180-day wait. But ask your client that. How long can you go without your paycheck? And that'll give you a good idea of the elimination period or the waiting period that you should quote.
The next terms that you see on the screen are the most important aspect of a disability illustration. It's the disabling definition. The best disabling definition is the own occupation rider. Basically, how you're going to see it structured in a DI contract is your client's unable to perform the material and substantial duties of his or her regular occupation. So this is the most liberal form of disability. If your client cannot perform the duties of his or her current occupation, they're going to get their full monthly benefit amount. And that is important because they're going to get their full monthly benefit amount even if they're disabled from their current occupation and they decide to do something else. The best example of that would be if you had a client who was a surgeon and could no longer perform surgery. Maybe he developed a tremor, or him or her develops a tremor and can't perform surgery, but maybe could go be a general practice doctor or go teach at a medical school. If that were the case, no matter how much income they're bringing in with that second occupation, if they can't perform surgery, they're going to get their full benefit amount. Secondly, the second most desirable own occupation definition is modified ONOC. Basically, it's the same thing. If your client cannot perform the material and substantial duties of his or her occupation and not working and doing something else, they will get their full benefit amount. And what I mean by that is the only caveat is if your client decided to go out and try to do another occupation after being deemed disabled from their current occupation, then the carrier will take a look at how much they're making in that second occupation and then reduce the benefit amount. But I would never hesitate to use that definition because it's a good way to get the premium down because O&O can be pretty expensive. The third rider is any occupation, or the third disabling definition is any occupation. This is the least desirable. They're going to not only take a look at whether or not your client can perform his or her current occupation, but they'll also take a look at your client's educational background and work background, and if they can't perform any occupation, then they'll deem your client disabled. That's something you might want to stay away from. I would certainly look at ONOC and modified before I would look at that definition.
Yeah, those are good points, Andrew. And I'd like to point out the true ONOC definition, that's really going to be important for your professionals, for those people that have specialties. Like Andrew's example, a doctor, that's going to be important to them. If their main duties are surgery and they can't no longer perform surgery, but you know they're still capable of doing another profession or occupation, they're going to be able to double dip. They're going to get their full benefit from the carrier, and then they're going to get whatever they're earning at the other occupation. So the true ONOC is really what we say is the sizzle that sells the steak. It's the best definition out there. But I also agree with Andrew when he says the modified is very strong, and not everybody needs true own occupation. Even though it sounds great, what if you have an executive that sits behind a desk all day, uses the computer, is on the phone doing inside sales? If they become disabled and they can no longer do that, we'll ask them, what do you think they could really go do? Is there anything, if you can't sit behind a desk or talk on the phone or use a computer, which are very, basically office duties, what occupation out there can you go do something else and you're going to be able to get both your benefit from the carrier plus whatever you're earning? So that's why I'm glad Andrew points out the modified is not a bad definition, and the best part about it is the carrier does not force you back to work. That's your choice. It's the client's choice. So always feel comfortable with those two definitions. Both very strong.
Yeah, I'm going to go into what a renewability provision is on a disability contract. Again, other than the disabling disability definition, the renewability provision is probably the most important, because when you receive a DI contract, probably the first thing the client's going to ask is, are these premiums locked in, or are they going to try to change the premiums on me at a later date? Well, that brings me to the non-cancelable and guaranteed renewable provision. This is the most desirable because whatever premium is listed is going to be the premium that your client's going to pay for the entire length of the contract. The carrier can never raise their premiums or change any provision on the contract. Now, that's definitely the most desirable, but it tends to be the most expensive. So that leads into just guaranteed renewable. Again, the carrier cannot change your client's contract in the sense of removing any riders or raising any premiums. But what they can do with the guaranteed renewable contract is raise the premiums on everybody in your client's occupation class in that state. So it's not as desirable as a non-cancelable contract, but again, that rarely happens on guaranteed renewable contracts in DI. They rarely raise the premiums on everybody. But if you want to pay for the security, then you would definitely want the non-cancelable rider. The third provision is the conditionally renewable provision. You're not going to see this very much. They're more so on association discounts, association programs and group policies. Basically, they put provisions on the contract. Your client has to be working full-time. If not, they can cancel your client or change the benefit amounts. Again, you're not going to see that very often. It's mostly going to be non-cancelable or guaranteed renewable.
Yeah, the non-can product definitely is, as Andrew pointed out, it's really for the peace of mind. Your rates are locked in, they're never going to go up. The guaranteed renewable or the GR contract, as Andrew pointed out, there is verbiage in there that says they reserve the right to do it. However, what we typically do, what we see the carriers do is just come out with new products because the states don't like it when carriers are going to try to raise rates on existing policyholders. It's got to go through the state insurance board, as Andrew mentioned, and it wouldn't just be for your client; it has to be for everybody in that class. So that's good. Is there anything you want to add to that, Andrew?
It's just a great sales idea. A lot of people who inquire about disability insurance are in their late 40s, early 50s, and that's at the time when you start to see disability contracts getting a little bit expensive. So again, I would never hesitate to use the guaranteed renewable provision with a modified O&O definition because we want to try to get the premiums down at that point in time.
Yeah, good point. Excellent. Well, let me talk about some of the what-if provisions. These are already built into the contract, so let me go through these. The presumptive clause. The carriers are going to presume you to be totally disabled if you lose your loss of sight, hearing, or speech, any one of those three, and you lose the loss of two or more limbs, like perhaps the client had a stroke and they can't move their left arm and their left leg, or whatever. It's two or more limbs, loss of sight, loss of speech, and loss of hearing. You're going to get that monthly benefit immediately because they're going to presume you to be totally disabled, and guess what else? Most contracts, they'll pay that just to age 67 if that's what you quoted. Well, guess what? If you have an age 67 benefit period, the carrier will actually pay you lifetime if you become presumptively disabled. So jot that down. It's your speech, the hearing, and the eyesight. Recurrent disability clause. This is built into the contract that states if your client becomes disabled, they go out on claim. Let's say they go out on claim for a back issue and they're out for a year. Well, after 1 year, they're feeling better. They've gone through the rehab. They're ready to go back to work. So they go back to work, but guess what happens 3 months down the line? The disability recurs. This provision allows you to go back on claim, allows the client to go back on claim without having to wait that elimination period again. So it waives the elimination period. This does, however, need to take place within a certain time period, and typically it's either 6 months or 1 year, depending on the carrier, and it needs to be from the same or related cause. So the back injury example that I used, something must happen to the back again in order for them to go back on claim without waiting the elimination period. If it's a totally different disablement or sickness or injury, then you would have to wait the elimination period again. But recurrent is built into the contract. Concurrent disability clause. What this states is that they're not going to pay you for more than one claim at a time. So if you do have if you're out on a back claim, and heaven forbid you're also diagnosed with cancer, you're only getting one monthly benefit. They're not going to double the monthly benefit. So it's only one claim at a time. Waiver of premium. This is important. The client needs to know that if they do go out on a disability claim, once they fulfill the elimination period, they no longer have to pay the premium on the contract. So while they're out on disability, the premiums are waived. That's built in on every policy, on all the carriers we represent. Rehabilitation. This is a benefit that's built in. And the reason why it's built in is the carriers want the prospect to go back to work, and they want to help them get back to work. And more often than not, your client probably isn't going to want to sit at home all day. They're going to do their best to get back to what they were doing before, probably because it's part of their routine and they were making good money. Whatever the reasons may be. But the rehabilitation benefit says these carriers, on top of the monthly benefit they're already paying you, will give you additional support, and it could be monetarily, where they may pay for you to go to physical therapy and do some rehab. Or maybe they write you a check to remodel your office so that you're able to work in it if you need more comfortable chairs or furniture or bigger computer screen, whatever it may be that's going to help you rehab and get back to what you were doing before. The carriers want to assist with that. Transplant cosmetic surgery benefit, just like it sounds. If you have a DI policy and you go in for some type of organ transplant or you have a cosmetic surgery and you become disabled due to that surgery, carriers are going to pay you your monthly benefit. And then finally, survivor benefit. If the client were to pass away while they're on claim, then a benefit would be paid to a beneficiary, next of kin, spouse, whoever it may be, and that's typically a 3-month lump sum if they were to pass away while they were on claim. So keep that in mind. Okay, well, I mentioned earlier there's also other things that we can add to the proposals or add to the contract that's going to strengthen it. I'll let Andrew talk a little bit about these, and as I mentioned, the what if, those are all built in. These are what we can show you in addition to what's already built into the contract. Andrew already touched on the ONOC, but Andrew, why don't you give us a little refresher?
Yeah, well, just to let you know, these added policy features that you can add onto a contract, they're important because, yeah, we already know how much the client can get when they're totally disabled, and we now know the disabling definition, but there's different aspects that could happen during a disability. Firstly, the own occupation definition, we went over that. That's usually purchased as a rider. So using that example again of the surgeon, if the surgeon cannot perform surgery anymore, he'll get his full benefit amount even if he decides to go back and teach at a medical school or be a general practice doctor. So you can receive your full benefit amount even if you go and you seek other employment and bring in other income. What is the residual benefit? I think this is one of the most important riders you should always add on to a disability contract. Whenever you see residual benefits, think partial disability. So with residual, it's not an all or nothing deal. You can collect a partial disability if you, due to a partial disability, you've lost at least 20% of your income. And so you can put in a claim. A lot of times you can get up to 60, even up to 100% of your benefit for the first 6 months, depending on the carrier. So it's not an all or nothing proposition. A lot of times someone can get disabled and the physician will say, well, yeah, you're disabled, but you can certainly put in part-time work. Your income's definitely going to be affected. And so we use that affected income to get a partial benefit. Future increase option. This is really important. Your client might be in his 30s, early 40s, come in and be able to purchase a DI contract and then receive a huge bonus or an increase in income. Well, that person probably doesn't want to have to fill out the paperwork again and go through all the paramed exams. So what you do is you purchase the future increase option on the existing disability contract in order to get more coverage without having to go through medical underwriting. All they're going to require is financial documentation.
Yeah, that's huge. I mean, that's the biggest point that Andrew points out there is with that FPO rider or future increase rider, you can exercise more to protect more of your paycheck in the future without any medical underwriting. Because we all know things can happen, and if somebody were to be diagnosed with something or their health has declined, but they want to do, or they want to get more coverage, sometimes they might get declined. But with the future increase option, no decline no matter what your current state of health is.
All right. I get a lot of questions on the supplemental social insurance benefit rider. Basically, when you see that rider, think of it as an additional benefit. And what the carrier is going to require, so let's use the example, my client becomes disabled. He has a portion of his benefit in the base benefit and then a portion of benefit in the Social Security rider, what a lot of carriers call it. The carrier will require your client to apply for federal Social Security disability at time of claim. If your client is turned down from federal Social Security, whatever benefit amount is listed under that rider will come from the carrier. Now, if your client is accepted into the Social Security program, then that benefit amount will come from the federal government, and then the carrier will not pay the rider. But the good thing to note is, however the case, the client's going to get that total benefit amount, whether it comes from the carrier or the federal government. The cost of living adjustment. This allows your client, while on claim, to adjust to inflation. And how it works is your client will get a percentage of benefit while he's on claim for at least 1 year added to his benefit. It could be a simple 3 or 6% added, or it could be linked to the consumer price index, so linked off of literal inflation. And this is good to have on a contract if you have a younger client, because it can be a costly rider, can add 20 to 30%. But if you have anybody in their late 40s, early 50s, think about it. You have to be on disability for 1 full year in order for this rider to come into effect, and it can add quite a bit of premium. So that might be one of the riders you might want to leave off if cost is a real issue. But again, if you have a younger person, I would definitely encourage you to put it on there. The automatic increase rider. So the cost of living rider adds benefit while you're on disability. The automatic increase rider adds benefit while you're paying your premiums to keep up for inflation. And it's usually a fixed percentage amount. It usually lasts for about 5 years. Basically, it's a free rider to have usually on your contract, but your premiums will be adjusted as the percentage of income is added to the monthly benefit amount. Some more riders. Return to premium is a real attractive rider. A lot of people inquire about it. Basically, if your client has good health history while he's paying his claims or paying the monthly premiums, then some carriers offer this rider to allow your client to receive some of the premiums back at a later date. It's not really the most attractive rider because it adds quite a bit of premium. But if your clients are inquiring about it, let them know that we have several carriers that offer this, and certainly will give high percentage of your premiums back if your client is healthy and not gone out on claim. The catastrophic rider. This is really important. Basically what it is an additional benefit if your client is catastrophically disabled. And how do they determine catastrophic disability is your client has lost the ability to have activities of daily living. Like your client can no longer feed him or herself, or can't dress him or herself, or maybe he's had a cognitive problem like Alzheimer's diagnosed. Well, this allows you to have additional benefit amount added to your monthly benefit amount because they understand that's a catastrophic disability. Lastly, the non-disabling injuries. This is just with one of our carriers, Union Central, but it's a great thing that they add on, and this is actually something that's free. If your client requires medical treatment or it's prescribed by like a physician or a dentist, they'll pay for the expenses up to 1/2 of your monthly benefit amount, and it basically is your client was not totally disabled, but has incurred some expenses. So it really helps out with your medical insurance if your medical insurance isn't covering certain things.
Definitely. Excellent. Well, thank you, Andrew. Folks, we're coming up on the 30-minute mark, so I'm going to try to get through this one quickly and then get to some questions and show you a quick sales idea. But anyway, some of the common DI exclusions and limitations you may find on DI contracts are mental nervous, crime, war, alcohol, and drugs. Now, carriers these days are becoming a little bit more lenient and liberal when it comes to the mental nervous in terms of exclusions and limitations. And I think the reason for that is there are a lot of people out there that are currently taking or being prescribed medication that treats depression and anxiety. That being said, the most common thing that you'll see is not an exclusion for mental nervous, but limited to paying a claim for only 2 years unless the client becomes hospitalized or institutionalized. Again, let me point out, carriers are starting to somewhat adjust that where they will cover a full mental nervous claim out to age 67, but don't be surprised if you see a limitation on any illustration or quote that you request, and it says, hey, mental nervous, so I'm going to pay you for 2 years unless your client becomes hospitalized. Crime. Crime is excluded if you are the one that committed the crime and you got disabled. That should be pretty obvious. If your client committed some type of crime and harmed themselves or became disabled, guess what? The carrier is not going to pay that claim. Obviously, if you were the victim of a crime and something had happened to you which made you unable to go to work, then it would pay. But for obvious reasons, if you commit a crime, that's not going to pay. War. If for some reason your client finds themselves in a territory where there is a declared war occurring, and you may want to check, I think the U.S. government has a list of the countries currently that are on the no travel or the dangerous places. So any country right there that's listed as being almost a war zone, such as anywhere in the Middle East right now, Iraq still, Afghanistan, I'm sure some places, maybe Libya with everything going on over there. If your client's over there and they become disabled, they get sick, the carrier's not going to pay. That's an active or declared war zone. Now, however, if the client is a victim of a terrorist attack, then the carriers would pay the claim. So an example of that, 9/11. Anybody who became disabled during that attack that had a disability policy, that would pay a claim. Alcohol and drugs, again, this is similar to the mental and nervous. Where they typically don't exclude it, but you are disabled due to some type of alcohol or drug-related disability. Okay, well, folks, that was the what-if provisions and the riders that you can add, the renewability of the contract, the disabling definitions that we've gone over. I think you've all hopefully gained something from that and hopefully found it to be very informative. I think you all have successfully passed this crash course, this DI 101. It's going to help you feel more comfortable and confident when you're talking about paycheck protection to your clients. So thank you for that. Again, I can't emphasize enough the disability facts and that stat pack that we have. Here's two more good ones that I'll quickly point out. At age 32, the chance of being disabled for 90 days is 6.5 times greater than the chance of death. And 17% or 1 in 6 families will experience a disability. So here's the most important question. Without their paychecks, how are they going to afford to continue to live their lifestyle and afford to keep their other assets, their home, their cars, whatever it may be, you know, putting food on the table for that matter. Anyways, be sure, you know, that's what you want to really drive home when you're talking to your client, is using these stats and these facts and letting them know that the risk is real. I'm going to quickly do a sales idea for you, and it's going to help you overcome the objection of price, because this is often one of the other challenges that a lot of agents face when they're out there selling disability insurance. It can be expensive. You know, it's more expensive than life insurance, and it's more expensive for females on the DI side. Well, here's just a quick way to help emphasize that that this can be an affordable product. As you see on the screen here is a sample illustration. This happens to be from Standard. We show a monthly benefit, which is circled with $5,000. And what are we doing? We're showing the annual premium of $2,449. Now, this is the wrong way to present it. Why is that? And it's not your fault. This is the way the quote request is coming back to you. We're showing the lowest benefit at the highest premium. And if I'm just looking at this, if I'm a client and I see, well, I have to pay almost $2,500 and I only get $5,000 a month, you know, that's not aesthetically pleasing just looking at it. So this is what I want you to do. Very simple. We're going to pull out our calculators, our Blackberries, our iPhones, and we're doing some simple math. I want you to present it this way. See that $5,000 per month? Let's show what the true total value of this contract is. We quoted out to age 67. The client's 35 years old. So if they were to become disabled tomorrow, that's the potential of collecting a DI benefit for 32 years. So take your $5,000, multiply that over the span of 32 years. Your total is going to be $1.9 million of tax-free benefit, just over $1.9 million. Why is it tax-free? More often than not, these policies are paid for out of the client's pocket, post-tax dollars, so it's going to be a tax-free benefit. If you have your employer pay for this benefit and you become disabled, then it would be taxable. But most of the time, they're tax-free. It really depends on how it's paid, basically. Just remember that. Anyways, $1.9 million tax-free. Now, that net annual premium that we have circled, what I want you to do is divide that by 365 days. And we're going to show how much it costs per day to protect the total value of this contract, which is $1.9 million. So for $6.71 per day, you are now protecting the potential to receive $1.9 million if the client becomes sick or injured and they can't work. Now, what I would do is I would take my red pen, Sharpie, whatever I'm using, and I would write $1.9 million right across the summary page. And I would cross out the annual, and I would show it on a daily cost basis. This is just one little tip to help overcome that price objection. As I said, it's one of the things I think one of the reasons why I think a lot of agents do fail when it comes to selling paycheck protection is because it's expensive. So any little tips or sales ideas we can give you, try it. Let us know. And you don't have to do this when you're just selling disability insurance. You should be doing this no matter what you're selling. Life insurance, whatever it is, always show the biggest bang for the buck, the true value, the highest denomination of benefit at the lowest denomination of cost. Anyways, that's going to wrap it up for Andrew and myself. Here is our website. If you have not been there before, I strongly encourage you to check it out. It's very user-friendly, meant for you, the agent, where you can go and request quotes that come directly to us. You can access articles. You can listen to previous webinars that we've done in the past, get applications, whatever it may be. This is for you, all access to make things easier. And always you can give us a call. You can ask for Andrew, who is out there in the sales department, or myself for materials, whatever you need. 800 numbers right there. At this point, I'm going to go quickly through to see if there's any questions. I know we're about 5 minutes over, but again, this is a very important conversation or presentation. I hope you folks have learned something, and I appreciate you being here. Andrew, would you like to add anything while I check to see if we've got any questions?
Yeah, I just want to thank everybody for joining us for today's presentation. If you missed anything or if you needed a little bit more clarification on anything, a summary of today's presentation will be sent out to you later on today. Just to let you know, our sales team has a ton of experience, so if you have any questions regarding a current prospect or if any questions on a DI contract, please feel free to give us a call. We always guarantee a 24-hour turnaround on our quotes, and I would be remiss not to mention that we have a fully staffed underwriting department that will help you with your applications, with your contracting forms. They're a great bunch of people. Just to mention real quickly, next week we have a great presentation on multi-life discounts. I think you should definitely attend that. We're going to teach you some great methods on how to make quotes cheaper for your clients and to increase the amount of premium you can bring in.
Excellent. Thanks, Andrew. I got a couple questions. Sandra, a good question. Are these policies available to people over age 65 and that are still working? The answer to that question is yes. We represent a carrier, which is Lloyd's of London, which I'm sure many of you have heard of, that will insure somebody over age 65. It does depend on what their occupation is and how many hours they're working, but they would need to be full-time. We will check the income, but we have at times been able to get illustrations for somebody that's 70 years old and still working. So if you have a client that's older than age 60, do not hesitate to contact us. And that goes for anyone, folks. I mean, you may think that you have clients that you've worked with in the past that are not going to qualify for DI and maybe declined because of health issues or other type of issues. Well, you know what? Give it a shot. I promise you that we might not always have the solution, but we work with 12 carriers that hit all areas of the marketplace, from your white collar, blue collar, gray collar, to impaired risk, to the older clientele, like Sandra's pointed out here. Let us know. If you don't think they're going to qualify, run it by us first. We'll do some research for you, and we'll let you know. Louis, you're asking a good question. Return of premium, how does that affect the commission? I will have to double-check that, and it may reduce the commission, not by much, maybe 5 to 10%, but I will contact you directly and get you that answer. It may be that it doesn't affect it at all. It might depend on the carrier. Let's see, Jack's question. What is the average commission rates for disability, and what carriers do you represent? Well, the carriers that we work with are Principal, The Standard, MetLife, Union Central. Those are really good for top, I'd say, carriers for white collar and professionals. We work with Assurity, Illinois Mutual, Mutual of Omaha, which are a good target for your more office management, maybe gray collar, blue collar. We work with Lloyd's of London for the special circumstances. Maybe it's a high-risk occupation or the age of the client, health issues. Fidelity Security, which is our impaired risk carrier. We can always go to them if we have a serious health issue. We represent, help me out here, Andrew, Presidential in New York, which is our impaired risk carrier, and American General. And I will point out, American General is only used by us for critical illness, which is another product that we offer. So not only do we definitely focus a lot on the long-term individual DI, but we have a critical illness product along with a long-term care product. I'll let you know, Jack, it's typically street-level comp, 50% first year with 5% renewals. We do not take any of your commissions. I want you guys to know that. We simply receive overrides from the carriers. So we don't touch your commissions at all. And it does depend on the carrier, what the commission may be, but typically it's 50% street level. And Louis, again, I'm going to have to research this return of premium question. Andrew and myself will do that, and we'll contact you via email, or you feel free to give us a call, because I'm not sure how that works when the client collects the return of premium. I don't think that's going to affect any chargebacks, but we will research it for you. Anyways, folks, thank you so much again for being here, and we've enjoyed our time today. We look forward to seeing you on future webinars. On behalf of Andrew and the rest of us here at DIS, I hope you have a wonderful day and enjoy the rest of your week. If there are any questions, do not hesitate to give us a call. Thank you. Have a good day.